Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of UltraTech Cement Limited. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that the company faces. The company assumes no responsibility to publicly amend, modify, or revise any forward-looking statement on the basis of any subsequent development, information, or events or otherwise. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Atul Daga, Executive Director and CFO of the company. Thank you, and over to you, Mr. Daga.
Thank you so much. Good evening and a very warm welcome to all of you to this earnings call of UltraTech Cement. As was expected, this quarter has not been good for the industry as well as ourselves alike. Lots of things happened which went not in favor of the industry, which are clearly reflected in our numbers as well. Let me talk about all the negatives first, and there is lots of good things also to talk about. Firstly, the monsoons. As you are already seeing, everybody is aware, monsoons have been so erratic. It seems to be a dramatic ecological change that is taking place in the country. Excessive monsoons have been there almost all parts of the country except maybe some areas like Tamil Nadu or Assam and Meghalaya, which saw lesser rains. Delayed exit of monsoons has been causing some amount of pressure on cement consumption and construction activity, and it remains to be seen how the delayed exit of monsoons will impact the crops. We'll have to wait and watch. Costs is the next item which I would want to touch upon, and as I had mentioned in the call during the last quarter, the costs are still elevated, continue to remain high, primarily driven by the rising prices of fuel. There was a brief period of merriment when petcoke prices dropped to 170 and everybody thought that this reduction is permanent. I'm sure many players interested in petcoke would have booked some contracts between 170 190, but today, as of yesterday, in fact, the prices of petcoke are back to 205 plus. There was some news about Venezuelan supplies as well. However, we were advised not to venture into Venezuela supplies due to the US sanctions. And coal is stuck around $300, $350, softened up a bit, but still very high, not yet worth buying for most of the cement players, as there is a significant arbitrage in petcoke. A few years ago, it used to be opposite. Petcoke was expensive as compared to coal. In our analysis, the geopolitical situation continues to be the driver for determining the costs or the trends or the direction in which the fuel costs will move. China is always the sleeping giant. Today the Chinese economy is down, but I'm sure China will revive, open up at some point or the other. Europe has started its coal-fired engines because of the ongoing war in Europe, in the Russia-Ukraine war, which is also sucking up a lot of coal supplies. Our view is that fuel costs will remain high due to the ongoing geopolitical scenario, albeit we have seen the worst on coal and petcoke prices. Hopefully they should not go up further. Crude has softened a bit. but we'll have to wait till the government decides to pass on the benefit to industrial consumers. We'll have to wait and see in the manner in which it is passed on and how much is passed on. During this quarter, UltraTech has completed shutdown work on almost 19 of its kilns out of the total 43 kilns? Out of the total 43 kilns. Maintenance costs have been higher because of inflationary pressure on refractory brick costs and other maintenance costs. Prices were under pressure during the towards the end of May 22, and they saw a continuous slide. Monsoons don't see any opportunity in increasing prices. However, the first available opportunity that the industry saw, I believe, in pockets where demand has been good, price increases have been attempted. Some price increases have settled, some have not settled in the country. Typical of the Indian cyclical cement industry, the season for cement starts after the festive season is over, which is after Diwali. So Diwali ends 24th and maybe 25th of this month, and you should start seeing improvement in the market sentiment on all factors after that only. One negative aspect about the rising prices of fuel is large cash flows are getting blocked in costlier working capital. After enjoying a long run of negative working capital, we had no choice but to give up the gains with rising costs, and identifying pockets of opportunities to buy cheaper fuel, we have increased our inventories, which has resulted in increase in our working capital. However, I am confident that in the next 6 months, as volumes go up, as the cost of purchase of fuel stabilizes, working capital will go back into the negative working capital zone before the end of this fiscal year. There is no reason why the industry will not take prices up, since the margins are continuously under pressure. Let me now talk about the positive side. Demand has been good, and that is the most important factor, most heartwarming factor from our perspective. On an increased capacity, we increased about 4.5 million tons of capacity YOY. On an increased capacity, our domestic volumes have grown about 10%. This could have been higher, but for the heavy monsoons. Improvement in capacities bodes well for profitability and cash flows. Good capacity utilization is the key. Good capacity utilization would easily help increase prices. This year and the next year definitely can be delivering a double-digit growth. Why? Well, because the first half itself, as UltraTech, we have recorded about an average of 14% growth despite a weak monsoon quarter. And as you are all aware, that demand starts picking up post-November, and March is a peak period. So definitely we should be able to deliver double-digit growth this year and next year as well. During the quarter, we've commissioned about 32 megawatts of renewable energy, taking the total to 318 megawatts, and which makes it to 5.6% of our total power consumption. An additional 5 megawatt WHRS was also commissioned. Birla White continues to strengthen its position in the industry. Putty expansion that we had undertaken from 6.8, what was our capacity? 4 lakh tons of additional capacity has been commissioned. It's under trial runs now, and 4 lakh has been commissioned. It's under trial production, and we hope to commercialize the plant before the end of this month or mid-November. Imports from Rack White will further strengthen the brand presence in the country. I believe the first shipment will happen during this quarter. We have been steadily growing our construction chemicals business, which recorded revenues of about 132 crores, up from 82 crores last year. On our growth plans, we are again ready to ride the high demand cycle with additional capacity getting commissioned. During the reported period, we commissioned Dalla brownfield expansion of 1.3 million tons, ending this quarter at 115.85 million tons of capacity. Pali greenfield plant and Dhar brownfield expansion is almost ready to roll out production, and we should see commissioning of these plants in the October-December quarter. We are on course, on track to reach 131.25 million tons of capacity by the end of March 22, which will be fully available for the next fiscal year to meet the rising demand and generate additional cash flows for the company and the shareholders. All this capacity expansion is being met out of internal accruals, and this year we expect cash outflow on capex of anywhere between 6,000 crores to 7,000 crores. We have already done in the first half of, I think 2,900 or 3,000 crores of cash has already been spent on capex in the first half. The phase 2 expansion of 22.6 million tons, which was announced last quarter, work has commenced. Almost 500 crores of spending has taken place on advance payments, labor mobilization. Some site civil work has already started. This is going to take us to our next milestone of 153 million tons of capacity by 25-26. A quick update on ESG. We continue to focus on reducing CO2 emissions with several collaborations and global tie-ups. 4 of our key cement products have been granted Environment Product Declaration. It's called EPD. This is a key step in our endeavor to drive sustainability in our business with a life cycle approach. With this, UltraTech's green product portfolio includes more than 70 Green Pro certified products. We continue our focus on improving our blending ratios. This quarter, yet again, we have gone up to 1.4243. Well, 1.41 as our conversion ratio. Blended cement continues to rise. Blended cement has reached about 71%, which helps us meet our carbon emission norm, our targets to reduce our carbon emissions. In the end, I'll conclude by saying that I believe cement is going to see a good time in the next few years, and for which UltraTech is very well prepared. Thank you, and over to you for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thank you for the opportunity. So my first question is with respect to the energy cost. I missed the opening remarks. So if you see both coal and petcoke, it's been quite volatile. It corrected from the peak sharply, but again has started increasing. So if you could just elaborate, I mean, how do we see on consumption basis our power and fuel costs shaping up in the next 2 quarters?
We believe that this quarter, the July-September quarter, was a peak cost, and we should start seeing marginal reduction in our consumption costs in the next 2 quarters.
Okay. I mean, okay. Is it possible to quantify?
No.
Okay. Generally, I mean, how many days of inventory are we carrying, and have we increased?
Our normal norm is about 45 days, and this time we have consciously gone up to 55 days. That is why I spelled out our working capital increase also taking place.
Understood. That's helpful. On the RM cost, we read the comment and also that index which you shared on the fly ash. It's up 8-9% quarter on quarter, which is a bit unusual. Is it possible to share, I mean, what sort of inflation are we seeing in other RMs like slag, gypsum, and also is this seasonal one-off spike or?
Rhonda, this is one-off. What happens is that in case there's a power plant shutdown, you have to source our fly ash from a next available power plant, which will be obviously further away. So the transportation cost goes up. There is no pattern that you can establish accordingly on fly ash cost.
Okay, understood. And just one last broad question on the overall M&A. And there are a lot of media reports on, say, JP Assets, India Cement, and few regional players in East and West. I mean, how do we see the M&A activity shaping up in the sector, and given a market share, what sort of, say, inorganic growth appetite do you see for UltraTech?
All I can share with you is to allay the confusion in minds of several people that given our size, we will get restricted on consolidation, but the geography is wide open for UltraTech to consolidate through inorganic routes also. We, as and when some opportunity surfaces in any part of the country, we will examine it.
Okay. All right. Thank you, Mr. Daga, and all the best.
Thank you.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Good afternoon, Mr. Daga. So, you just on the cost side, like in the presentation, it's mentioned that the power and fuel cost was $200. The fuel was $200 per ton. So this includes the domestic coal sourcing as well, or this is the imported fuel cost?
This is imported fuel cost.
Okay. And
coal for us is a very small percentage. 7 to 8% only.
Okay. And last time in the last call, you had mentioned that there were some cargoes of Russian coal and all which was taken. So was that there in this quarter, and the sourcing is continuing as of now?
So yes, it has started getting into consumption in this quarter, and it was an opportunistic trade. So in case something again surfaces, we will examine it.
Okay. And on the petcoke, like the spot prices, could you just shed some light on that? Like, what is the spot petcoke? Is it closer to like 200, or is it gone beyond that also?
Beyond 200 now. I mentioned on the call, I'm at 205.
Okay, I missed that. Okay, fine. That's all. Yeah, I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Ritesh from Investec. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity, sir. Couple of questions. Sir, first one is you indicated you are open to inorganic growth. Sir, how should we look at it? What are the things that you look at which will make us attract to the asset?
It's a very weird question. You see, our fundamental premise for evaluating any asset is a profitable growth opportunity. I'll pay a price on which I am able to generate return for shareholders. And we will buy an asset where we can increase our market presence. And I also had mentioned that India is a wide open geography for us as well.
Right. Sir, if I have to dig one step over here, sir, how would you look at versus the expansion optionality that we have on the table, which you have indicated like we are absolutely going full throttle. We have a pipeline which is actually workable. So if you look at the incremental ROC versus the optionality that we have on the table, how should one look at that comparative math on incremental ROC?
So incremental ROC or organic, obviously it is time value of money, and you get an inorganic opportunity. You hit the road running. That is the advantage that one would have on inorganic versus organic, and it depends on the price that you are paying. Today, organic would be costing absolutely greenfield. Where you start acquiring land also, it will cost $110, $120, give or take. So that is how, and if you start investing today, it will take you 7 years to put up that capacity. As compared to that, you might pay some premium. You will have to pay a premium over replacement cost, but you also get advantage of 7 years of market share and cash flows.
Sure. Sir, my second question is, we have indicated our... Third, sir. I have four total, so third question. Sir, we have indicated incremental expansion plans on the capacity side. Just wanted to have your thoughts on what are our plans on distribution, basically incremental railway heads, bulk cement terminals, optimizing sea freight, DFC. How should we look at all these four variables?
So, fleet expansion, we don't own fleet. Our transporters continuously add and wherever it is required. Our transporters who are associated with the organization, with the group for maybe 4 decades, they will expand their fleet as and when required. Our endeavor is to continuously increase the penetration in terms of dealer network. Today, our channel partner strength would be upwards of 1 lakh, close to 1,10,000 channel partners, and a continuously increasing number. DFC is opening up. I saw Rajasthan has already started double-story wagons. Of course, they have not yet been made available for cement, but I think things are opening up. As for bulk terminals, our expansion footprint is always planned in a manner where if a bulk terminal is required, we will take it into account upfront instead of waiting. For example, in the second phase of growth, we have two bulk terminals already planned, and any future requirement also, bulk terminals will be planned, grinding unit, so it will be a split grinding unit composition that will come into play. The last point that you mentioned about railway siding, there is no target.
Railway siding and sea freight.
And?
Sea freight.
Sorry, what? Sea route, ocean route. So, as far as railway sidings are concerned, I think we keep on adding wherever available, whenever available. Last count, I remember that going on 260 odd railheads. Yeah, 260 plus railheads. So it's not a top-down target, but operational efficiency improvement plan with which we keep on adding railway sidings. As far as ocean route is concerned, we We have our own jetty at our Gujarat plant, bulk terminals, 279 railway sidings as of now, bulk terminals along the coastline. There is Mumbai, that is JNPT, then it goes down to Mangalore also, right? Bulk terminal? Yeah. Bangalore, Cochin, so this is on the coastline. We will look at expanding our network on the eastern side as well. We don't have bulk terminals at the moment, but we look at expanding that network in our second, third phase of growth.
Perfect. Sir, just one last question. We have an interesting launch on white cement-based liquid primer.
Yes.
So just wanted to understand what is the rationale for it to be in UltraTech and why not graphene, given for my limited understanding it is better to bundle it with paints versus putty. Please correct for you. Thank you so much.
So, yeah, because the raw material is white cement and all the primer and putty-based products are done by UltraTech. That's why it's here.
Sure, sir. Thank you so much. Wish you good luck.
Thank you.
Thank you. The next question is from the line of Pratik Kumar from Jefferies. Please go ahead.
Hello. Yeah, good afternoon, sir. My first question is on utilization. You mentioned your overall utilization is around 76%. Can you throw some light on regional utilization, sir?
I'm sorry, and?
On regional utilizations, region-wise utilizations.
Region-wise utilization, so North was nearly 85%, Central was 70%, East was 90%, West was more than 60%, South was more than 75%.
How much you said for Central?
For?
Central region, how much you said?
70%, 70%.
Okay. Okay. And on, sir, pricing, overall it appears that we had like around a 2.5% grey cement realization decline or 2 to 3% decline on a sequential basis. How would that be region-wise?
Region-wise, I think East was the least impacted. North saw a decline. North and Central were the leaders in decline. East was better placed. West was neutral.
Sure. And in the presentation, you mentioned that there was a preponement of maintenance shutdown. Did that have any specific impact on cost, which was like sort of one-off?
The cost, I think my maintenance costs were higher than planned by about 80 crores. I think it was 80 crores, yeah.
So, like when you say the like for like, basically last year.
So what I mean was that we had original plan as per our annual budget. X number of kilns were planned. We did 3 more kilns than that in this period, and the spending was also higher, partly because of cost of procurement going higher, and partly because of additional work that was done.
And last question on your logistics cost. In the presentation, you mentioned diesel prices are lower, like for 5%, but like for like logistics cost is down 1%. So, is there any change in lead distance which is resulting in lower decline in logistics cost?
5% impact to 1% only.
Yeah. So diesel cost is not 100% logistics cost.
Only 40% on road.
Quarter on quarter. Anything else?
Sure, sir. These are my questions. Thank you.
Thank you.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you, sir. Sir, just wanted some color on East market. You did mention.
I can't hear you.
Sorry to interrupt, but maybe request you to move to answer.
On East market. you mentioned that East prices have relatively held up better than the other regions. But this is also a region where we would see the maximum capacity addition over the next 2 quarters. And the presentation highlights that Chhattisgarh and Orissa had seen degrowth due to sand mining ban. Given this context, how do you see the East markets at this point of time? Is demand going to get further impacted because of what's happening in Chhattisgarh and Orissa?
I believe Pinakin East will be the best performing market in terms of demand, and that is why I think nobody is a fool to add additional capacity in that market. There is a big science or big rationale which each player is having to add capacity in that market. So this additional capacity will get absorbed in East. Demand will continue to support. But don't want to get into comments on individual states or a point in time, because sand issues are here today, then something else will happen tomorrow. But if you look at the underlying demand, underlying capacity utilization, in this quarter also, in fact, we had the highest within our capacity utilization in the East was the highest. I believe the industry, not just UltraTech, industry players will continue to enjoy a good capacity utilization in East.
Sure, sir. So my second question is basically, this is the second quarter where UltraTech's India realization seemed to have outperformed the peers. We had seen a larger than peer group increase in the first quarter, and we have seen a smaller than peer group decline in the second quarter. In your sense, sir, is this because of higher non-trade mix, more premium products, or specific regions, aiding this performance?
Should I reveal all my trade secrets to you? So value-added product is continuously going up. It's reached more than 18% now. That is one area. We are increasing our blended cement ratios, increasing our trade ratios as well. So everything, and plus there has to be some respect that you should give to UltraTech as a brand. So we have historically commanded superior pricing as compared to the other players, and I believe UltraTech will continue to do so.
Understood. Thank you very much, sir.
Thank you. The next question is from the line of Pulkit from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Just one question. You mentioned that it is because of monsoon having a prolonged impact that demand got impacted. Now, our understanding was that July and August were weak months and September is actually a relatively stronger month. Would that be correct, that we are exited September at a much stronger volume print, or is it the other way around based on what you just said? So just wanted
if I remember it right, Pulkit, all the months have shown growth. And yes, I think my colleague confirms September was higher growth as compared to the other months. But each month we have seen growth.
Okay, so we can expect that since September exit was a stronger month and now that we are off monsoon, hopefully this momentum should continue for us.
Sure, I will just not go with that statement of yours, we are off monsoon. I don't know whether the monsoons are off or not.
Sure. Okay, yeah, that was it from my side. Thank you, sir.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, good afternoon. I have two questions. First, sir, on capital allocation going ahead, right? So assuming at 131 million ton capacity, we will be able to sell close to 100 million ton, if not more, and should generate close to 12,000 crore of EBITDA annually. Even with 6,000 crore of capex, we'll have significant amount of free cash flow to make it net cash positive in 2 years at best. So any thoughts on, other than inorganic expansion, return of cash to shareholders or anything?
That is always there. I think we increased the dividend allocation to the dividend allocation was increased to 20% year before last. And now we are again looking at growth. So as I said, this quarter, whilst we had an positive operating cash flow, but net cash after capex was negative. We have capex happening in 24, 25 as well, and a shade of part of 26 will also see an extra amount of capex. If you will recall, 2 years ago or 3 years ago, our average annual capex would be plus minus 2,000 crores, and now we are going to see plus minus 6,000 crores for the next 2 or 3 years. Having said that, we are still on course to be, or we are delayed as of now because of the cash flow being used for capex. Otherwise, we would have been the net cash already in this year. I expect net cash to be on the balance sheet towards the end of March 24.
Sure, this is helpful. Second, calendar 23 will be the pre-election year, and if there has to be any significant bump up on infra activity, demand from infra, government spending, we should have seen some bit of pre-ordering already. Are you seeing any signs of that yet?
Not yet. I think we expect more than what is happening. See, the good part is that demand is, we have recorded 10% growth domestic sales in this heavier monsoon quarter. So obviously there is a positive direction in which the orders are flowing and cement consumption is happening, and I expect it should go up further.
So that buoyancy you see in the rural residential part as well, or
yes, yes.
All right. Thank you. Thank you so much for your answers.
Thank you.
Thank you. The next question is from the line of Navin Sahadev from Edelweiss Securities. Please go ahead.
Yeah. Good evening, sir.
Hi.
Yeah. Can you hear me? Am I audible?
Yes, loud and clear.
Right. Thank you so much. So, sir, the previous questions, thank you for giving the region-wise color on utilizations as well as realization. Is it possible to get some trend on profitability? For example, your average EBITDA per ton was more like 800 rupees. So is it possible to get which regions are a little more profitable than these and others lag around?
I don't have that at the moment.
Very broadly. I know numbers.
So, if I look at the prices, so then obviously South would be the leader in profitability, followed by West, and North catches up, along with East is of course at the last step in terms of profitability. Central and North would be up behind South and West.
Got it. Thank you. This is helpful. Sir, my second question then was about your fuel mix. So presentation says 40% is pet coke, and I think you also mentioned imported coal is 7 to 8%, if I heard that correctly.
Domestic coal is 7 to 8%.
Okay. So if you could just give me the overall fuel mix, please, both in the kilns and power plants.
Just 1 second. Power cost. What number? So indigenous coal 15%, imported coal 46%.
Okay. So okay, I get it. So
one second. This is TPP per kiln. Yeah. I should look at kiln separately. Kiln indigenous coal in kiln was 5%, imported coal was 50%, pet coke was 40%, alternate fuel was about 5.2%. That's in the kiln.
Understood. And the earlier number was for TPP, the 46%?
We don't have TPP separately. The hybrid number with TPP plus kiln. Is there TPP? 1 second, it is there. So TPP indigenous coal 56%, imported coal 29%, pet coke 5%, others 10%. Lignite, which is essentially an alternate fuel.
So sir, the thing on the kiln split, because you mentioned that pet coke is far more favorable in terms of cost. So the imported coal that we are using is at par to that cost because of better sourcing, or it's conscious that we don't want to go higher on the pet coke consumption front?
No, we have to balance the pet coke coal mix, and our coal procurement is far more efficient than anybody else's.
Yeah, but it still is higher than pet coke on a landed basis even now, right? So are we looking at increasing pet coke considerably from 40% currently, or it will still, this is what max it is?
It can go up to 50 to 60%.
Okay. So which basically then means that if this mix is changing, Q3 can then see a very meaningful decline in the cost? I mean, of course, the spot prices are higher.
The cost will come down for Q3.
Before it takes up again because spot prices are again. I'm saying before it takes up again because spot prices are.
Naveen, we cannot really start annualizing spot prices. So our game plan, we will deliver lower cost this quarter and lower cost next quarter.
Understood. And then just my last question. You mentioned working capital as the prime reason, but if, for that increase in debt, net debt position. So given that these fuel prices are again sort of bottoming out, may we say, or going up, is it fair to say that this working capital funds will stay locked even for March, or that would still...
No. I think I had mentioned, and I would have requested you to listen to my commentary more carefully. We would get into a negative working capital zone before the end of March. With volumes going up, will be one big driver for more cash collections takes place with higher volumes. Inventories we have now reached about 54 or 55 days. By the end of March, we will come down to our normal level of 45 days. So that will release cash. Cost of purchase will be lower as of now. So nobody knows how prices will actually pan out. But our planning is to release working capital cash by March for sure.
No, great. I did hear your comment. I was just confirming because since the fuel prices are wherever they are today.
But that's today, yeah. So correct. There was a time when the pet coke was 170 and everybody started annualizing it. That was not the right thing to do. Correct. We'll have to. This is the most unpredictable times that we are going through.
Sure. And just one last confirmation. Did you say we have spent about close to 3,000 crore in capex so far into the year?
First half, yes.
Okay. Because I'm just looking at your balance sheet and the capital work in progress or even total property, plant and equipment. These numbers are up like about 800 crore odd each, which is 1,600 crore. Just trying to understand.
A lot of advance would be there. That is one point which I can think of. But advance also will be CWIP, right? So
no, capital advances are reported separately.
Yeah. So capital advances also you need to add, but I don't know what the accounting issue is, but I can get an explanation sent to you separately.
Sure. That will be really helpful. But thank you so much for answering and all the very best. Thank you.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good evening. So firstly, on coal, you made a comment that pet coke will go to like 50-60%. So given the current pet coke and coal prices, ideally we should be going to 70-80% pet coke, right? So is there anything constraining us on that front?
So there are technical constraints. That's all I know, that there are technical constraints. in the earlier days when petcoke was, darling of the industry, those days also we had tested and we reached about 78% peak. So there is some issue with blending. Limestone from mine to mine has different qualities, because of which you cannot mix 100% petcoke. Second point would be availability. As in when petcoke is available, one would pick up shipments of petcoke.
Right. But okay, got it, sir. So secondly, in terms of the from let's say growth plans outside, the organic plans that we have, if we have to explore M&A, like any specific region, where both we are interested and we will not even face regulatory issues in terms of, our market share and those kind of stuff, can you point where our strategy?
I'm interested in India for organic opportunities. I will not have regulatory issues in any geography in the country.
Okay, got it.
At this stage where we are, I don't know,
right.
5 years, 6 years later.
Right. Okay, got it. So lastly, just a housekeeping question.
I think we have evaluated through all the lenses that the regulators look at and what is the requirement. So we are well within the norms.
Right. So just a couple of housekeeping questions. One, what was the share of blended cement this quarter? Sorry, trade cement this quarter?
Trade was 68%.
Okay. And then secondly, you spoke about the chemical business revenues, which is crossed 100 crores this time. In our segmentation, where do we put that? Is it in grey cement or it's in others?
It's very small, less than 10%. So it does not. Less than 1%. Yeah. So there's no segmentation.
No.
They doesn't get
I know that.
It is part of cement.
Sir, what I meant was
part of cement only, Ashish.
Part of cement. Okay, got it. Thank you so much, sir.
Thank you, Ashish.
Thank you. The next question is from the line of Girish Chaudhary from Spark Capital. Please go ahead.
Hi. Thanks for taking my question. Firstly, would like to get your sense on the industry's supply dynamics. Are you worried of a potential build-up or a surprise in the overall supply? With also the new entrant infusing significant amount of money and some of the other larger players having a strong balance sheet. So just wanted to get your sense on the supply dynamics. That's the first one.
So my guess is that all the supply which comes in, organic supply, will get absorbed easily.
Okay.
Because you see, India as a story will show you much higher growth as compared to any other market, because there's a huge amount of development required, there's a huge amount of housing required. That's it's a no-brainer statement which I'm making. But yeah, India will see a huge amount of cement consumption happening for a few years. In the next few years can be 10 years, more than 10 years. That I don't know, but as of now, it's still a very long distance away. India also reaches a saturation point and growth tapers down. So as long as there is growth potential, additional capacity will get absorbed. And one more point one needs to keep in mind, that total capacity that one looks at is a myth, because there are lots of capacities which are non-operational, lots of capacities which are inefficient or shut. So effective capacity, available capacity is lower than the nameplate capacity that you might be tracking.
Got it. Fair enough. And secondly, if I look at your phase 1 and phase 2 capacity addition plan, which is roughly around 40+ million ton of addition. West is a region which is seeing very low capacity coming in, roughly around 1.8 million tons. So any reasons why a lower addition here? Is it to do with reserves or utilizations, or are you looking at inorganic?
I'm not able to hear you clearly. Which region you picked up as low addition?
I think West. If you look at West, you're adding only 1.8 million tons. So between phase 1 and phase 2?
West is more a GU, no?
Yeah, so you're just adding, yeah.
Yeah, mines is not a constraint, and West, luckily we have coastal plants, so I can bring limestone from the Middle East in case of so limestone as a resource is not a constraint in the Western market. West, we have enough capacity available, and we don't put surplus capacity, and create problems for us. We will put up capacity where we feel that we need additional volumes right now.
Got it. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. I don't know if you have already answered this.
I answered
on the fuel? Hi sir. Could you talk on the fuel cost on a per kilocal basis? How was it in Q2 and versus Q1?
2489 rupees per million kcal was the cost in Q2 as compared to 2215 in the previous quarter. And if I go back 1 year, Q2 FY22, it was 1427. So 1427 has come up to 2489.
2489, okay. And sir, in this quarter, how are the numbers currently in October?
We'll talk in January.
That's okay. I'm just directionally, is it coming off?
What is coming off?
Quarter on quarter, do you see this number coming off versus what you saw in Q2?
The fuel cost.
Yeah, fuel cost per kilocal.
Fuel will come off.
Okay. I think that is all from my end. Thank you.
Thanks, Rajesh.
Thank you. The next question is from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah. Thanks for the opportunity, sir. So just one question on the cost side, like say going forward, like say in couple of years, what quantum of cost reduction do you see, like say be it freight side or power and fuel cost? So
about 100 rupees a ton would definitely come out of cost reduction, minimum.
On the variable side?
On the?
Variable side.
Yes.
Okay. And sir, like say in the presentation we have mentioned 19.5% as the mix of the renewable power. So is it in terms of the capacity or in terms of the power usage in this quarter? Okay.
Actual generation, actual consumption, whatever you want to call it.
Okay. And sir, lastly, like you have 40-odd% share of pet coke. So vis-a-vis imported coal, because this 2489 looks to be very competitive as compared to what thermal coal prices are. So is it the case that the grade of the imported coal which we are using is also equally competitive as compared to the pet coke?
Yeah.
Because like say if we see
you get US coal is very high grade coal. 6,900, no? 6,900 kcal.
Normally we are not buying RB1.
Okay. So that would be RB3 or all that. So that's why that is also competitive as compared to the. Okay. Great sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah. Thank you, sir. Sir, what was the lead distance in this quarter?
What are the lead distance size?
428.
428 kilometers.
Okay. Sir, you mentioned that regulatory issue will not be there. You have taken care of that in terms of the inorganic expansion. But just trying to further understand, for my understanding, in terms of, let's say, if you go for a, let's say, Nuvoco acquisition, I'm just giving an example. So how do the CCI look at?
I don't look at specifics. You can ask a general question if you have.
I'm asking a general in terms of the market share, how the CCI looks at any percentage, what are the broad criteria that the CCI looks at post the acquisition, 10, 15, 20% market share should not be there?
I think that I will not be able to answer.
Okay. Third, sir, just trying to understand in terms of the second phase of expansion, 22.6, how much broadly from that would be we would be commissioning in FY24?
Maybe 3 or 4 million.
Okay, and rest mostly by March of FY25.
And some might go into 26 also, fiscal 26. It means first half of 25-26.
Okay. Got it. Thank you.
Thank you. The next question is from the line of Sanjay Nandi from Ratnabali Investment. Please go ahead.
Yeah. Good evening, sir. Thank you for the opportunity. Sir, we have seen some spike in the employee cost in this particular quarter. Can you please throw some colors on that, sir?
Spike in annual increments. We follow an increment cycle from July, 1st July.
Okay.
Our
okay,
increments are, evaluation done in March, given effect in July. So July, June is our annual cycle.
Okay, thank you so much, sir, for the opportunity. Happy Diwali, sir.
Same to you.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity again. So just on white cement and putty, like the RAK acquisition that you had made, so that is supposed to kind of flow in additional volumes into India. So by when is that expected to start?
This quarter, they will start. October-December quarter should be starting volumes. So packing material has already reached there, quality, etc., all settled, logistics tied up. So this quarter shipment should happen. Start happening.
Okay. And the exports to Sri Lanka, like, is there anything happening or it's completely stopped?
Very marginal. So only in case we have secured rupee LC available, which is opening up. So against those LCs only we are exporting. So exports have dropped down dramatically from maybe 1.5 lakh tons per month, give or take 1.5 lakh to 30,000 or 40,000, 2 shipments only. And one more reason, I'm glad you asked about Sri Lanka. Our working capital, so we have close to 200 crores due from our Sri Lanka operation. The money is lying there. Government is releasing money gradually. We received about 40 crores last quarter, in the reported quarter, and I believe that money will get regularized in the next 2 quarters or 3 quarters.
Got it. And what was the export volume in Q2, absolute number?
1 lakh tons.
Okay, got it. Thanks, wishing you happy Diwali.
Happy Diwali to you.
Thank you. The next question is from the line of Ritesh from Investec. Please go ahead.
Sir, 2 questions. First is, sir, if I heard it right, you indicated on TPP we have 5% pet coke and 56% local coal. So my question is, why pet coke is at only 5%? I remember like 2017 something, there was a court judgment.
So,
So
what was the court judgment?
I think it did restrict the usage of pet coke when it comes to power plants, but for kilns it was allowed because of the quality of limestone and limestone saturation factor.
Yeah.
So, question is, can this number of 5% pet coke when it comes to TPP increase, and can it be a cost-saving lever?
In TPP, we use domestic coal, which is far more cheaper.
Right. But sir, you said 29% is imported and 5% is pet coke. So 29% imported versus 5% pet coke. Is there room for substitution?
Yeah, there is. So one is in the NCR and the related markets, pet coke is not allowed in power plants, that you are aware. And it's opportunity wherever we find financial economics working in favor of pet coke, we use that.
Sir, if my memory serves me right, it's only in 3 states wherein pet coke in TPP is not allowed. So
I'm sorry. Yeah, you're right. NCR, that is the market.
Okay. So can this number move up and surprise?
Could be. Given I don't have a ready answer actually, Ritesh.
Okay, fine. And sir, second quick question. Is there some changes which one can expect on the discounting trends in the marketplace? Is there some probability over here?
I have no idea about that.
Okay, no worries. Cool. Thank you so much, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of UltraTech Cement, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.